The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Hello and welcome to Your Money, Your Call. I'm Julia Lee from Bell Direct, and joining me on the panel tonight we're very lucky to have Nick Radge from the Chartist. And finally, a positive day for the market. We've now seen two positive days for the Australian share market in 2016, and I guess a lot of people are wondering, what do they do at this point in time? Let's ask both their panellists on what they think the market is going to do in 2016. Now, Nick, I know you're a momentum trader and, you've had some fantastic trades in 2015. 2016, are you starting to see some of that momentum unwinding? How are you seeing things?
Yeah, definitely unwinding. Obviously pretty bearish at the moment. We probed down into new lows yesterday, down through 4,900. Yesterday was actually not a bad day. We had to close off the lows, volume was light, and that generally means selling was dried up a little bit. So we're probably going to bounce. We saw a little bit of that today. In the US as well, we've had some pretty strong or pretty weak internals. I think last week we had a record number of put options bought in US equities, and generally when you get such an extreme reading like that, you tend to take the contrarian view. So I wouldn't be surprised to see a bit of a bounce over the coming weeks. We're stuck in a range at the moment anyway, 4,900 to 5,400. We'll probably go back right up into that range and maybe test again on the downside. If we break 4,900, well, I think the door's open for a move down towards 4,200.
Okay, so some very important technical levels there to be watching on the market.
The banks have had a good run, they've had their time in the sun, and I think we'll probably have an extended period of consolidation, best case. So I think, as you're right before, we'll see a bit of range trading, but I wouldn't expect to see new highs made anytime soon, probably not for 2016. So range trading, maybe even with a little bit more downside bias.
Okay, and I guess the other big question out there is it time to, be picking up the BHP Billetins and the Rio Tintos of the world? We've seen a little bit of support creeping in under that $15 level. Looking at BHP in particular, what are your thoughts around, the big BHP, the best digger of dirt in the world?
Yeah, look, the trend's firmly down. There's a lot of negative sentiment. We had a bit of capitulation the last couple of weeks, so we might get a bit of a short-term reprieve, but until that trend changes, and usually after such a substantial trend on the downside, we need to see some kind of basing pattern, which will take some time. If we can get a big base taking, 4, 5, 6 months and it breaks to the upside, then maybe it's worthy of taking a look at. But at the moment, falling knives, I wouldn't be touching it.
Do you have our first caller on the line? So first, let's go to Robert from Melbourne. Robert, welcome to the show. How can we help you out today?
Thanks, Julie, for the opportunity to speak. Just two companies I got in mind is one is McPherson's, MCP.
Sure.
And if we've got time, GUD. Thank you.
Sure. So having a look at McPherson's first, and I think they're across a number of different areas, one of them being beauty. They own, I think, brands like Manicare as well as some of the more premium brands that are sold in healthcare shops like, I think it's Aiken that they sell. Share price, though, hasn't been doing so well. Looking at this one, Nick, I'll start off with you. What's your view on this one?
Yeah, well, here's an example, kind of what I was talking about with regard to BHP. McPherson, obviously a completely different business, but from a technical perspective, trend perspective, we've had that big downtrend that's been in place for a number of years now, and we've now started to move sideways. So it looks like the selling is complete. We're forming that big base. The base has been going since August last year, and that's the kind of thing we want to see with BHP and some of those other miners that have tanked recently. So at this one, look, it's looking okay. It's not time to get in my view, because these ranges can go on for extended periods of time, and you'd be better off putting your capital to a stock that's actually moving than one that is just sitting there in a range. Very low liquidity, this one, so it's not really going to interest us, but a break up through 80 cents would probably get the momentum in a positive frame of mind to look for some upside, but until then I'd be steering clear.
The other stock was GUD Holdings. GUD is the stock code there. Household appliances and auto parts as well. It's rallied from a low of around about $7 in October. It's just under that $8 mark at the moment. What do you think?
Yeah, look, we're still seeing lower lows and lower highs, so the trend really hasn't turned up as yet. If we got a break up through that kind of, 850 area again, get a little bit more upside momentum, but broadly speaking, it's still range bound. It has been in this position since September 2014, more or less. There's been some ups and downs, but from a sustainable trend perspective, that really hasn't broken out anywhere as yet, and I'd like to see that happen before getting involved.
Okay, so that was GUD Holdings. We also have another caller on the line, so let's go straight to Nathan from Melbourne. Nathan, welcome to the show. How can we help you out today?
Hi guys, I'm calling about two stocks.
Sure.
The first one is SDI Limited. They do sort of, dental products, etc.
Yes.
And the other one is Infomedia, IFM. If I can get the panel's opinion, that would be fantastic.
Sure, let's start off with SDI. It has been, I guess, a little bit all over the shop. It's about $70 million market capitalisation, so it's not a huge stock. Nick, we'll start off with you. What are your thoughts on this one?
Well, very low liquidity. This is the first thing I see, and really price hasn't done much. Okay, again, it's been range bound, but it really hasn't done a great deal since mid-2014. We'd have to see prices get up through that sort of 65-cent area to get some upside momentum, but wouldn't be one for us. Very low liquidity, but nothing really going on. No trends there that really take my fancy.
Okay, so another one that has yet to deliver, and probably Infomedia is probably one you'd put in the same basket. With the share price though, Nick, are you seeing any signs of life there?
Look, it's a stock that trends exceptionally well when it gets going. So what you want to do, if you can capture the start of some new trend, is jump on board and stay with it, because it does go very, very nicely. But at the moment, the trend is down. If I was to say anything, the downside momentum has certainly slowed of late. It looks like it's trying to form a little bit of a base, but the warning there is that bases can remain in place for quite some time, and your money might be tied up with this stock not doing a great deal. So I'd be looking for a breakout, probably up through that 80-cent mark before getting involved again. The risk is until that happens, we'll stay in the range or even maybe go a little bit lower, but once it gets going, it does go well.
And we now have Joanne on the line from Melbourne. Joanne, welcome to the show.
Thank you, Julia, and thank you for taking my call. I'd just like to ask the panel, please, about a stock called BPF, which is called Bulletproof Group, which is to do with the cloud.
Sure.
And I was wondering what they thought about that.
Sure, so having a look at Bulletproof, it looks like this one was a backdoor listing, so it started on the market in 2014, and it's been a little bit of a roller coaster ride for the company. It's traded as low as, I think, around about 18 cents.
Yep.
And as high as sort of where it is now, or where it has been in the last few weeks, at 53 cents. So lots going on there. Looking at cloud, they look at services, so if you want to be on the cloud or access Amazon Cloud, they help you out. They try and market themselves, as you know. We're there 24/7. If you need something, you can give us a call. Nick, what are your thoughts around the share price?
Yeah, look, I mean, it's obviously moving in the right direction from where I stand from a momentum perspective. Interestingly enough, the highs we hit the other day are also the highest highs the stock has ever hit before, back in late 2013, 2014. So a bit of resistance there, which is probably why it's pulled back a little bit. Very strong support around 39 cents. So as Matt says, if it's fundamentally quite strong, then any dip down to around that area probably would be well supported. But yeah, look, there's momentum moving. It's quite volatile, so you've got to give it a little bit of room to move, but it's certainly going in the right direction.
Okay, so that's Bulletproof, if you're interested in that one. Let's go to our next caller. We've got Vince on the line from Queensland. Vince, welcome to the show. How can we help
Thanks,
you
Julia.
out?
Thanks for taking my call.
You're welcome. How can we help you out today?
I'd like the panel's opinion on a couple of stocks. One's a small tech company called Sanitas. They deal in cybersecurity hardware. And the other one is Challenger Financial.
Sure. Let's start off with Sanitas. A beautiful looking chart there. And I guess in this type of world where we're constantly using internet and computers, security is a big issue, and being able to encrypt and protect yourself from data thieves, especially given the very high-profile hacking scandals that we've seen in the past year. I mean, the US government, Australian government facilities as well. Yeah, absolutely.
None of us were affected.
So looking at Sanitas, I mean, the share price has gone from strength to strength. And I know, Nick, that you're a momentum trader. Is the momentum still on the side of Sanitas, or it's on running out of steam?
No, it's it's still moving in the right direction. We're seeing higher highs, higher lows. It's always a good thing. We've got some all-time highs just above here at around that 22, 23 cents. Usually the first retest of an all-time high, you'll see the stock stall. So Vince, expect that to occur if we do go up that way. This stock trends very, very well when it gets going. And by all accounts, it will probably retest those highs. It's doing it slowly but surely at the moment, but we're in a bearish environment, broader market here, and you know, that considered, I think it's going quite well. So first target, expect a pause around that 22, 23 cent old high.
The other stock was Challenger Financial Group. Now, the stock price doesn't look as attractive as that last chart that we saw of Cinetes, SEN. Challenger Financial Group, CGF, is the stock code. It's Australia's largest retail provider of annuities. The stock price looks pretty good on a one-year scale. Looking at this one, would you be buying into this story at this stage, Nick?
I don't know about buying into the story. We don't know what the story is, but in terms of the momentum, we're already long this in our large cap portfolio. It's pulled back a little bit and probably pretty close to our capitulation point, where we define the momentum has changed enough to exit the position. Unfortunately, we did break into new high ground and just reverse straight back out of that. So quite good support a little bit below around that 710 area. Wouldn't be surprised it would hold that as a worst case scenario. So if you are fundamentally interested in it, that's kind of your area where you can lean against and get into that stock. But look, it trends well when it gets going. Unfortunately, market environment at the moment's got the better of it, and it's got a bit of negative wind in front of it at the moment.
So we've seen a lot of the financial stocks falling back just with the market volatility that we've seen in 2016 so far. Challenger, though, you know, it should be benefiting from a large portion of the population moving from that accumulation stage into the retirement stage. And, you know, superannuation is compulsory here in Australia. Nick, are you finding long opportunities in this environment?
We've been in a defensive mode for some time. I think personally I'm probably 50% invested in the Australian market. You know, in the US market I'm 100% cash. Happy to be that way, but that's the way we operate, you know. When the market's good, we want to be involved. When the market's bad, we don't want to be involved. I mean, it seems a bit logical, but it goes against what most people will do. Patience is what's required here. It's not a sprint. Warren Buffett didn't make his money from a one-year run or a six-month run. It's just the way it goes, the good and the bad. You've just got to take both of them. You've got to expect to have both of them, and it's just taking the longer-term view. Okay, and what are some signs before you'd wait till jumping back in? Again, momentum. It's all about just positive price movement. You know, if you want to buy stocks, the only way you can make money is when the share price is going up. That's what we wait for. We don't predict. We don't sit back and buy companies that may turn around at some time in the future. If they're going to move, we want to be on it, just like a hitchhiker. You know, we want to jump on that ride when it's moving, for when it's moving, and when it stops, we'll hop off it, and that's what it'll do. If we get a big bullish environment, we'll be on board, we'll ride it. If we get a big GFC again, who knows, doubt it, but we won't be involved in it, and that's all we're trying to do, and over the longer term, that's how we'll outperform. At the moment, we do have another caller on the line, so let's go to John from WA. John, welcome to the show. How can we help you out today?
Hi, Julia. I was just ringing up about a company called Blackham Resources, a small cap explorer that is due to go into production. They've increased their reserves. They've got their plan organised. All the ducks seem to be in line, and they've got the money in the tank ready to go. And their cash costs seem to be around about 900 Aussie, with the Aussie dollar falling and the gold price kicking up. Their cash profit seems to be, or will be, quite reasonable. I just wanted to know, do you expect the stock to be re-rated once they start producing?
Sure. John, do you own the stock?
Absolutely.
Oh, congratulations. That's a beautiful looking chart right there. And you're absolutely right. The Aussie dollar gold miners have been doing extremely well, especially companies like Blackham. It's very unusual for a resource to come online at the right time. And I guess this could be an inflection point that Matt was possibly looking at. If the production cost is around $900, the Aussie dollar gold price is around $1,500 and rising at the moment because of the fall in the Aussie dollar, as well as the stabilisation in terms of the gold price and hopefully the moving higher of the gold price, Blackham would be in a pretty good position. It's going to be more than $500, closer to $600 because of the fall in the Aussie dollar and the rise in terms of gold. What are your thoughts around this one, Nick? Is it too early, or would you be taking a risk?
Look, share price is moving in the right direction. Big resistance there, John, at 28 cents. It's bounced off that a couple of times. I would like to see it test that and consolidate there for a little bit. If we can stick at that 28 cent level, you might be in for a more solid breakout, a more sustainable kind of breakout there. But I'm never one to avoid a stock that's moving in the right direction. That's what we want. So 28 cents is kind of the line in the sand for me. If we can get up there and just hold for a little while, then move higher, I think that will be a much better proposition.
Let's go to our next caller. We've got Andrew on the line from Brisbane. Andrew, welcome. How can we help you out?
Yeah, g'day Julia. Macquarie Group's come back to $71 plus. Just wondering whether this is a buying here or do we go lower from this point?
Look, it's a really good question. I mean, looking at Macquarie Group, on one hand, you know, you have that falling Aussie dollar and the exposure to US earnings, and then on the other hand, it is exposed to the market, and the market's been seeing quite a bit of volatility. We might start off with a technical view this time because we are coming up to sort of an important level for Macquarie. It has bounced around that $70 mark in the past. Will it do it again? Nick, would you be taking a view on this one?
Well, we're certainly at the lower end of the range, as Andrew has quite rightly pointed out, and the $64 million question, which no one can really answer because no one can predict the future, is whether or not we hold there. If you're a punting man and you're looking to add to a position or put a position on, you can lean against this moderate minor support here at 70 cents. $70. I wouldn't call it anything major. And if we do break down through there, well, you know, we'll slip back down to that $55, $60 area where we first came from last year. So bottom end of the range, if it holds the range, well, this will obviously be a very, very good buying opportunity. The good thing leaning against support is you can have a pretty tight stop loss if you believe in stop losses. Not everyone does, but from a trading perspective, buying here with a very tight stop loss gives you, if you're right, some upside potential to get a nice risk reward out of that trade. As I said at the start of the show, I don't think banks are going anywhere too far too fast. Trend is certainly down at the moment in Macquarie Bank, and it's a reasonable aggressive stance to be buying right here in my personal view.
Nick, I can't believe how many stocks are trading like Macquarie is at the moment. A pretty big range between $85 to $70, but you know, it's hit it a number of times and potentially could continue to do so. Is this going to be something that, you know, traders are going to be doing commonly?
Absolutely, absolutely. I mean, I think that's the environment we're going to be in for the larger caps, and I think, you know, potentially that's going to be the trend in 2016. Banks have had a big run. They're now going to consolidate for a couple of years. That's a pretty normal cyclical kind of thing. Small caps are moving, and as Matt has said before, some of the smaller cap IT companies are really moving now, and that's where the big trends are. But in the larger caps, we're going to see that range congestion, and really CBA has been the one you want to watch, and I completely believe that CBA will not make new highs in 2016 and will do nothing but move sideways, and there will be opportunities in that sideways movement for the rest of the year.
Okay, let's go to our next caller. I've got Miraj on the line from Sydney. Welcome to the show. What's your question for our panel tonight?
Good evening, guys. My question is on QBE Insurance. Just wanted to know what the fundamentals and technicals. The share is trading at almost 10-year low. And do they have exposure in the oil sector as well?
What a great question to come through about QBE Insurance. I mean, at a time when the Federal Reserve is, you know, forecasting 4 rate hikes in 2016, you think that QBE shareholders would be jumping up and down, but unfortunately it looks like from this share price the market just doesn't believe the Federal Reserve's going to raise rates 4 times this year. How about you, Nick? Do you like QBE? Do you like Insurance Australia Group, Suncorp Metway?
Well, on QBE, we're coming back down to this level. We've spoken about this in the last few years, $9. Every time we come down here, we see buyers step right up to the plate again. It's not to say they'll do it this time. Obviously, things have changed considerably now that the Fed have started to move, and we're going the opposite way to what most people are expecting, and that's always a bit of a worry. So, trend's down. It's very range bound. That's about the most positive I can say about the stock, and we wouldn't be touching it down here in any way, shape, or form.
Okay, so no to QBE Insurance. Nick, how about Insurance Australia Group and Suncorp Metway? I know Insurance Australia Group, if we can bring up the chart for IAG, doesn't look as bad as Suncorp Metway, which is kind of looking horrible, but is there any hope for any of these insurers?
Well, again, it's, I mean, IAG is doing what all the other major large caps are doing, and it's trading sideways. You know, it had this superb run in 2012 up through 2014, and it's now moving sideways. You know, it'll have its day in the sun again, but again, at this stage, moving sideways. The risks are to the downside at the moment. We're testing the lower end of the range. Again, it just shows that the larger caps, they're done. They're done for the moment. Smaller caps is where you want to be, and that may last a couple of years.
Okay, so looking away from some of the big blue chip names that have dominated portfolios over the last few years, in fact the last few decades, let's go to our next call. We've got Jim on the line from Perth. Jim, welcome to the show. How can we help you out?
Yes, good evening, panel. Just wanted a technical view on Oncosil OSL and probably some price targets, if that's possible. Thank you.
Sure. So Oncosil, so we'll go to Nick for some price targets on Oncosil.
Well, let's have a look at that. It's a pretty volatile stock, very low liquidity. We've just broken up to new all-time highs up where we are now, so we're above the major highs that we've been before. So ideally, Jim, if we can consolidate here for a month or so, that would be a very, very positive sign. Consolidate above that 22 cents, that would be helpful. Wouldn't like to see it come down below 18 cents. But it's had a good move, jumped up there, obviously some kind of announcement. Usually a consolidation after that kind of an announcement is the next stepping stone to further moves. But we're in uncharted territory up here, and that's always a good thing if you're holding the stock. If you're not holding the stock and you're looking to get on board, wait for the consolidation, another week or so, and if it breaks to the upside, just jump on board.
Oh, thank God I bought into the stock at 10 cents and 16 cents. But one of the specky ones in my portfolio, and I guess often it gets compared to a Certex, but it's nowhere near a Certex. It's very much at the early stage of its journey, whereas Certex is already producing revenue. So very risky, very speculative, but still looking at both liver cancer as well as pancreatic cancer, which we know things move pretty quickly in this area. So that was the Oncosil. OSL is the stock code there. And we now have Max on the line from Perth. Max, welcome to the show. How can we help you out?
Happy New Year,
Happy
Julie,
New
and to the
Year.
guys. As I'm not an expert, I'd like some global coverage, and I was thinking of HGG,
Sure.
the Henderson one, and also your thoughts on BTT.
Sure.
Thank you very much.
Max is asking about some of those money managers out there which have done fantastically well through the global financial crisis. I think both Henderson Group and BT Management up more than 150% since, you know, sort of the middle of the global financial crisis in mid-2008. They've done really well compared to the market, which is down 5% in that time, unfortunately, if you don't include dividends. But now we're seeing them in a little bit of trouble. Both of these companies have large exposure to Europe, Henderson Group especially, but also BT Investments through their Hambro investment or the acquisition they made a few years ago. And I guess one of the reasons why these money managers based over in Europe and focus in that region is because, you know, European markets, the FTSE has been hitting new highs in 2015. So these money managers have been collecting their performance fees, funds under management have grown. Is that still going to be the case in 2016, or are we going to see a different environment?
Well, I think we are seeing a different environment now. I mean, there's a lot of negative sentiment around, and until that, you know, that stays in place, we've got concerns with China, we've got concerns with the Fed, although I don't think they're going to continue to tighten interest rates. But you're quite right. You know, these companies have had great runs, and we're now seeing the consolidation. As far as HGG goes, you know, we can pull back towards that $5 area, maybe a little bit lower. 475 would be very good support. Fundamentally, if you like them, that's kind of your area that you want to be buying them down there. And for all intents and purposes, we're going to stay in this range, which we're now in. Personally, I was just in BTT and exited that week or so ago, so gives you my opinion on that. Probably HGG looks a little better in my personal view. BTT has come back to support. Yeah, so I think we're going to see a broader consolidation in both of those for the near term.
Let's go to our next caller. We've got Grant from Hobart. Grant, welcome to the show. How can we help you out?
Good evening. Just inquiring your thoughts on ESI, which are in a trading halt at the moment awaiting an announcement. Closed at 029, I believe, today.
Sure. So having a look at ESI, it is the smallest stock on the market, $75 million market cap. Just before it did go into trading halt, though, we saw the shares absolutely shooting up. So I wonder if it's a good news story there that might have leaked out, because certainly the chart seems to be saying something. Nick, what's going on there? Do we see a rise in volumes as well?
Yeah, well, it's one of those stocks that has these little runs at times and reverses very, very quickly. Obviously, a lot of speculative money getting in and getting out. So, I mean, it's a bit of a coin toss as to what's going on. Obviously, it looks like it's going to be positive news. I mean, it's really bolted up. And big resistance up there at around, what's that, 3.5 or so. So hard to say. I mean, it could go either way, but historically when the stock does have these big rises, they reverse pretty quick smart. So if you do get on a bit of that, David, you probably might want to take a little off the table if it's offered to you.
Let's go to another email. This one's from David, who asks, the price of 3P Learning has dropped around 25% since the resignation of the CEO just over 1 week ago. It appears to be good value at these prices, but just how important was the departure of the CEO to the company's future growth? Well, we've seen a few CEO departures over the last week, and unfortunately every time we seem to hear an announcement and there isn't a huge reason being given, we see a drop of about 30% during the session, which is massively huge for a single stock. I mean, it seems a fantastic area to be in, you know, these software for maths programs, reading programs to help students at primary and high schools. I mean, I was sent to the Kumon learning system from the age of 5, so, you know, I love stuff like this, but the share price I certainly don't like. Nick, what do you think?
That's what the market's telling you right now. They're not happy with what's happened. That's why it's dropped 30%. Looks like considerable capitulations taken on there. The trick now would be to watch the volume, although this is a very low liquidity stock. Normally, once you've got some capitulation, you'll see some consolidation, the selling dry up, and when that range or base starts to form, that's the time to step back in. But at the moment, it's still early days. The unknown question is how much selling is still sitting out there to come back in again if the opportunity arises. But all-time lows there, not looking particularly positive.
We do have an email here from Vincent, and Vincent asks, what's the panel's view on Godfrey's Group? In light of their recent profit downgrade and the change in CEO, do you consider it to be a buy, hold or sell?
Looks a bit like Dick Smith, really, doesn't it?
Oh no, don't do that.
Well, as you know, my book, Unholy Grails, I listed every single stock that went bankrupt and they all show the exact same pattern. Well, that's it right there, and Dick Smith showed it a couple of weeks ago. I'm not saying it's going bankrupt, I'm just saying it's showing the exact same kind of pattern. And gapping down, trending down, gapping down, it doesn't look particularly good. There is absolutely no evidence right here, right now, of any kind of a turnaround, and therefore your risks are still to the downside. And I would suggest if there's going to be a turnaround, it'll be a very slow affair, so there's absolutely no reason to get involved now.
We also have an email here from Josephine, and Josephine asks, there seems to be a lot of positive news on CIMIC Group, but this doesn't seem to have been reflected in the share price. What does the panel think of this company? CIMIC Group's also been doing a lot of takeovers. It owns stakes of about 30-40%. It's been trying to mop up a lot of the shares it doesn't own in some of those smaller investments that haven't been performing so well, which is why the shares might be underperforming, because they've been paying a premium to take over some of these companies. However, you know, there's been a lot of good news coming out of CIMIC as well. I think the latest one, CIMIC announced that takeover offer for Sedgman Group, but they also announced a takeover offer for Divine as well. So there's been a couple running there.
Yeah, well, apart from a small excursion late last year, it's really been stuck in a range of between $20 and $25 since very early 2014. So very choppy, sideways activity. Looked like I wanted to get on with it and just reversed very quickly with maybe with the current market environment that's caused that. But yeah, it's back into the range now. It may stay there for some time.
It is a difficult market, and I guess a lot of people out there have been looking for opportunities in this market. So I might put you on the spot a little bit and ask about some of the opportunities or some of the favourite trades and stocks that you've been looking at in the type of market that we're in.
One of the best positions I've got at the moment is SIQ, Smart Group. We've been in that since about $1.80, and been trending up very, very nicely. It's pulled back lately, giving us a bit of a shake on today's price action, but we're still holding in there. The other one that's been doing very well for us is CKF, Collins Foods, been trending along very, very nicely. Did well today. So we don't really try and position ourselves into a particular part of the market. We simply go with the flow. My personal focus is on small cap industrials. They've been doing well for the last year or so, not exceptionally well, but certainly better than the large caps. But then again, they were out of the limelight for the 2 or 3 years prior to that. So they're coming back into a bit more positive sentiment now, and we'll just stay with those trends. But I'm 50% cash at the moment, and there's not too much going on.
And I guess it's an inflection point for a lot of technical trends as well, potentially. Nick, how do you handle anything?
Well, prices will tend to gap in the direction of the prevailing trend, and we are usually on stocks that are trending up. I mean, Certex was one we got caught out on. Any upgrades in earnings, whatever, will come through favourably and we're already priced into the market beforehand. So we take a two-step approach. We really don't look at earnings per se. We view that as noise in the market. But we take a two-step approach from a macro perspective. What's the trend of the broader market? And then we'll step it down to the individual stocks themselves and say, right, what's the trend of the individual stock, and go from there. And if they line up, then we've got a buy signal. If they don't, we stay in cash.
Okay, so really interesting that usually, even with earnings season, the stock's already trending and it tends to gap up in the direction of that trend.
Yeah, well, just look at Godfrey's the other day, right? We've been trending down, big gap down. Dick Smith Holding, trend down, big gap down. QBE, trend down, big gap down. They all do the same kind of thing. Tend to gap in the direction of the prevailing trend.
Okay, so earnings season coming up in February. Tune in for that. We do have another caller on the line, so let's now go to Andrew from New South Wales. Andrew, welcome to the show. How can we help you out?
I'd just like to see the panel's view on Technology One, TNE, and my net phone,
Sure.
MNF.
Two stocks that have been doing quite well, especially Technology One. My net phone as well over the last 5 years has been doing pretty well, as the stock chart looks fantastic, Nick.
Yeah, it does. Broke out to new highs late last year. The stock trends exceptionally well when it gets going, and that's something that we're always keeping an eye on. Look, the fact that it broke out late last year and has just pulled back in this negative sentiment that we've had in the last few weeks, I think it's actually quite a good thing. I think there's, some positive rate of change going on here. So again, I'd stress that maybe some consolidation. Once this negative sentiment is kind of out of the way, this trend will get on and keep moving higher. So one to certainly watch, and yeah, I think it looks quite good.
Okay, so TNE, Technology One, looking pretty good. What about MNF, my net phone? The telecom space, especially the smaller players in this area, have been doing quite well out of consolidation. My net phone, a lot of brokers have it as a buy at the moment. Some strong targets around about, I'm seeing $3.50 to that $4 mark. What do you think of this one? We might go to Nick.
Currently stuck in a range. Upper side of that range is $4. I'll stick with my standard spiel and say, whilst we're in the range, steer clear. If it moves to the bottom of the range, which is around that $3 mark, $3 is the bottom of the range. If you like the fundamentals, that's kind of your area to start putting the toe in and lean against that support. If it broke down through $3, I would be concerned. But really, we're range trading $3 to $4 and would want to break up through that $4 to get that trend going. Again, it's a stock that trends exceptionally well. Just hasn't had the upside in most recent times that Technology One has, but it's a nice consolidation considering the trend that preceded it.
Okay, so you'd be waiting for a break of that $4 mark,
yeah,
and then looking pretty positive. Sorry, I was wrong. Brokers have become more cautious on the stock since the guidance that was given at their annual general meeting. It looks like costs in terms of goodwill and things like that are declining, actually going up, so having a negative impact on earnings and forecast earnings.
PRY. Primary health.
What about primary healthcare? Nick, going to you on primary, it's been horrible. It's been in a downtrend, and then, the government came out with that mid-year review, and he talked about cutting costs for things like x-rays and pathology, and unfortunately that's not good news for stocks like primary healthcare, Sonic Healthcare, Capital Health, all that have come down since that announcement.
There's plenty of armchair critics out there of technical analysis and support and resistance, and I've heard a few big name fundamental guys put it to bed, but at the end of the day, these are the kind of reasons why some basic technical analysis can help you out. 420, 440 was a significant line in the sand for this stock. It sat above that level, tested it many, many times over a number of years, and when it went through there, it just cracked and has been one-way traffic ever since. And, you know, capital preservation is, in my view, as much a part of the game as picking the right stocks, you know. So it doesn't matter what you think fundamentally of primary healthcare, at the end of the day, you're losing a ton of money on it, it's going straight down, and there is absolutely nothing to suggest that's going to turn around anytime soon. So we're certainly not involved. Your level to get out here was 420, 440.
Okay, so that mid-year economic and fiscal outlook that came through from the government in December, certainly bad news, but they have been trending down before that as well.
That's right. That's the whole thing. It's been trending down for a long time before that came out.
Okay, we've got our next caller on the line, so let's go to Craig from Geelong. Craig, welcome to the show. How can we help you out?
Yeah, thanks, Julia. I was wondering whether the panel thinks that honey is going to be the next milk, actually. So Capilano Honey, CZZ.
This is one of those stocks that's been running up really well. Capilano Honey, pretty much dominating sort of supermarket when you go to buy honey. It's Capilano Honey, either in a tube or one of those funky-looking tube things. Nick, looking at the share price, what do you think?
Yeah, look, again, this is one of those standard cyclical things. The stock has just been belting upwards. It's been a fantastic trend over a number of years. So the fact that it's just having a consolidation now is a very, very healthy thing. Okay, it's pulled back a little bit, but I can't see that it's a significant change in trend. It might have been enough to put the brakes on some positions, but a consolidation after such a great trend is a very healthy thing in my view. I wouldn't get involved until we started to break out to new high ground again. It looks okay.
Now we've got just one final email from Andrew who asks, Select Harvest doesn't seem to be going anywhere but down. Does the panel think that the stock will rally?
Ooh.
Oh, almonds drowning California.
Yeah.
Nick, what do you think of this?
Well, it looks like it's certainly adjusting back to where it was beforehand. We have broken down through some significant support there at $7. So next stop on the downside is $5 at this stage. Be pretty concerned if it broke down through. Best case scenario, I think we might see consolidation between $5 and $7. But if it broke $5, I'd be certainly concerned. Trend is down, momentum is down. Yeah, there's no reason to be involved at the moment.
Okay, so when you see a trend like this, Nick, and someone's still in it, you know, it's unfortunate because you want to get out early and you want to be looking at the technicals, but, you know, for a longer-term investor who's stuck all that way, you know, what do you do?
Well, that's your payoff, right? Every strategy has a payoff of some degree, whatever it may be. So, yes, if you're looking for a significant long term, well, you've got to ride the ins and outs and make sure that the business is viable over the very long term, or at least pay some kind of good, solid dividend to offset these downside fluctuations. That's not what we're about, though. You know, we're just chasing the momentum and we're happy to get on and off. Sometimes we miss out as well. That's every strategy is going to have a downside to it.